Okay. All right, so welcome everybody. Thank you for joining us for our Making the Most of Your Legacy series. This is our third series that we are doing with Cereus Financial. So today's discussion will be all about smart beneficiary designation. So without further ado, before I pass it over to David, if anybody has any questions, just chat them in the box and we can have a discussion afterwards. And I'll read out those questions and David will answer. And at that time, whoever asked the question can, answer a little bit and have more of an open discussion. So now, without further ado, I'd like to pass it over to David Haas from Cereus Financial Advisors.
Okay, thank you, Jennifer. So we're going to talk about some basic estate planning and smart beneficiary designations. And there we go. First of all, a little bit about me. I'm a certified financial planner. I own Cereus Financial Advisors in Franklin Lakes, and I actually started off life as I didn't start off life as an electrical engineer, although I used to take things apart a lot. But I started my career as an electrical engineer, and then I got an MBA in finance and a certificate in financial planning later. I have been an active volunteer with several organizations, but also the New York, New Jersey Trail Conference, and I've served on the membership and development committee and the events committee. And Cereus Financial Advisors is a registered investment advisor in Franklin Lakes, as I said, and my contact information is here. And I don't know if you're interested in the slides, I guess you can contact Jennifer and we can send them to you. So today I'm going to talk a little bit about basic estate planning. I'm going to explain what passed by law, contract, and will mean. I'm going to talk about taxes, because whenever you talk about estate planning, you have to talk about taxes. I'm going to explain some things about life insurance, and then we're going to talk about beneficiary designation and what makes sense with the current laws, because they have changed recently. And we're going to talk about charitable beneficiaries, and I will present a checklist for you, which hopefully will be useful. So here's a special disclaimer. I am not a lawyer. So only attorneys can execute estate planning. Only attorneys can write wills. So I am telling you things from the point of view of a financial planner, but when it comes to the law, you have to talk to an attorney. So here's a little review about the way things get passed to beneficiaries. And there are three basic methods. It's passed by law, and we're going to talk about these in detail in the subsequent slides. So passed by law, passed by contract, and passed by your last will and testament. So let's talk about passed by law. This is meant for jointly owned property. So typically a couple would own property with both names on the deed. Joint tenants with right of survivorship is the most common one to inherit the property, although that can differ by state, what the designation is. And when one of the owners dies, the property is passed to the other owner automatically. It's passed by law. This is also the case if you jointly own a bank account, if you jointly own a securities account, which is possible. It's not that common, but it's possible. In those cases, what happens is the other owner will essentially inherit the entire account without any further intervention by anybody. Then we have pass by contract. So when you have a beneficiary designation on an IRA, a 401k, any kind of qualified retirement account, that's passed by contract. You have written a contract with those beneficiary designations, and the company that is custodying the account or custodying the account is going to, upon presentation of a death certificate, they are simply going to pay to whoever the beneficiary is. Now, this just doesn't just have to be qualified accounts. You can have a payable on death provision in a bank account. Just ask your bank and they'll add it for you. So that means it'll automatically go to the person that you've named. For securities accounts or stock, you can do transfer on death. So you can put that on your account, and it works the same way as payable on death. And of course, there's life insurance, and life insurance pays out to the designated beneficiary. And it also goes for annuities or other forms of retirement accounts. And then we have last will and testament. So the last will and testament, which is what everybody thinks of as estate planning, that covers everything that's not passed by law or contract. So what happens is, if you have, let's say you have an account, a securities account with $1 million in it, that's, at JP Morgan. If you have a transfer on death on that account will not go into your estate. It will not go to the will. And if your transfer on death says to transfer it to maybe only one child because you wrote that designation before you had 2 children, well, it's going to go to that one child. And even if your will later says you want to pass your accounts to both your children, the fact that you had that contract and you designated a beneficiary means that the will doesn't count. So everything that is mentioned by the will, everything that goes through the will, is considered a part of your probate estate. And the probate estate is overseen by the surrogates court in your county of residence. So if you reside, in Passaic County, New Jersey, the surrogate court in Passaic County, New Jersey is going to oversee the administration of your estate. That's the way it works in New Jersey, and I believe it works very similarly in New York, although I'm not sure if it's called the surrogates court in New York. When someone dies, an administrator is going to be appointed. That administrator is sometimes called an executor or an executrix. It's actually only an executor or executrix if the administrator was identified in the will. Otherwise, it's just called an administrator. Even if there's no will, an administrator is still going to be appointed, unless there's really no estate, and then there's no point. So a will, of course, can specify bequests, which means, I give my favorite teapot to my uncle because he really enjoys drinking tea. That's a bequest. Bequests could be charitable. And then the will is going to have a clause in it someplace further down, which is going to specify who gets the corpus of the estate, everything that wasn't mentioned in a bequest. And a will can create a trust. So that is very, it used to be very typical, but with the current estate rules, estate planning rules, it's not quite as common today. But a trust that's created in the will is called a testamentary trust. One important thing to realize is that you cannot leave anything directly to a minor in your will. So if somebody is a minor, if you have minor children or grandchildren who you're leaving something to, it does have to be left in trust, and that trust can be created in the will just by essentially mentioning it and explaining a few details about the trust, and that's called a testamentary trust. So there are non-testamentary trusts, which means a trust that wasn't created in the will, that is used for estate planning, and mostly those are revocable living trusts. This is a trust where everything in the trust is administered according to the language of the trust, which typically is going to say something about what happens when you die. And upon death, the trust becomes irrevocable, which means it can't be changed. So the trustee is in charge of administering the trust. Trusts avoid probate. You know, you're on late night, if you're watching things on late night TV, no doubt you've heard about avoiding probate. There's been a lot of ads about how to avoid probate over the years. Well, those ads are for Californians. Probate is terrible in California. It turns out that probate in New Jersey is really almost painless. There's a very small administrative fee. The administrator is appointed, and the court actually will help you if you ask questions. You don't even necessarily need an attorney, depending on the complexity of the estate. And you simply go through the probate, and at the end you tell the court. Actually, New Jersey, I don't even think you have to file to close the estate. It's that simple. So in New Jersey, generally, a living trust is really not necessary. New York is similar. I think New York has a little bit more court oversight. It's a little bit more expensive, but it's really pretty painless. Apparently, California is terrible, and it does vary from state to state. So, you know, your attorney will know. Attorneys love to draw up trusts, though, because they make a lot of money drawing up trusts. So keep that in mind. And but well, let's not say anything more about that. A trust may or may not avoid estate taxes, and we'll talk about estate taxes momentarily, like now. So there's two types of taxes to be concerned about in estate planning. One is the estate tax, and the other one is income taxes. Believe it or not, income taxes are, at this point in time, probably more concerning, or should be more concerning for people than estate taxes. So there are a couple things to know about income taxes. First of all, if you have non-qualified assets, which means something that is not in a retirement account, that may be your house, it may be, you know, some other real estate, it may be interests in a business if you happen to own a business, it may be your original Rembrandt painting hanging on your wall, or it could be shares of stock. Whatever it is, there's a step up in basis. And what that means is that when someone dies, the assumption of the cost of the item for income tax purposes is stepped up to whatever the current worth is. So if you sold something on the day somebody died, there would be no capital gain. So you wouldn't have to pay any taxes. So that's very important. And it's very important because it's actually a great income tax benefit. If you owned, if you bought shares in Amazon, 15 years ago, and you own those shares, and you think Amazon is doing great, you have this enormous capital gain in Amazon. One way to avoid that capital gain is to die owning those Amazon shares, because there'll be a step up in basis and your heirs will not pay any tax on it. So it is an interesting and important tax benefit. Now, qualified accounts work differently. So beneficiaries have to pay income tax on any tax-deferred qualified account. So if you die and you have $1 million IRA, and you were paying taxes on it as that IRA was being distributed to you every year, maybe a portion of it. If you die and you leave that IRA to an heir, that heir, whoever it is, doesn't matter who it is, will have to pay tax eventually when the money is removed from the IRA. Same thing with 401k, same thing with 403bs, same thing with annuities. There are financial advisors who are probably not certified financial planners who love annuities, and they do have a role, they can have a role, but annuities are very tax inefficient, especially when it comes to dying with them, because they are taxable as ordinary income. So estate taxes, that's your other kind of tax. There's currently a federal estate tax exclusion of the first 11,580,000 of anybody who dies. And the surviving spouse has their own $11,580,000 exclusion, and then they can also use the unused part of the previously deceased spouse's portion of their exclusion. It's called portability. So there's actually a $23 million exclusion right now for a couple. That means there's essentially no federal estate tax today, except for really quite rich people. However, in 2026, the estate tax exclusion is actually going to drop, because that's the Trump Tax Cut and Job Acts expires, and the exclusion is going to revert back down to $5 million, actually adjusted for inflation. So that is still a pretty decent size exclusion. So, but the estate tax may in fact affect more people. In New Jersey, there is no current estate tax. New York has an estate tax exclusion of $5,850,000. New York is kind of interesting because their estate tax is written so that although there's a $5,850,000 exclusion, if you have just $1 over that, your estate is taxable from $1. So if you happen to live in New York and you're fairly wealthy, you really want to watch out about being subjected to that estate tax, because it's probably avoidable. You want to do some more complicated planning. And important thing to know is that a U.S. citizen or permanent resident spouse can inherit unlimited amounts without an estate tax. One thing I should mention about New Jersey is New Jersey actually has an inheritance tax that's different than an estate tax. It taxes anything that's passed to non-direct lineal descendants. So if it's going to your children or your grandchildren, there's no tax. But if it's going to your, let's say your child's wife is not a lineal descendant, actually not directly related to you by blood, and therefore there's actually an inheritance tax in New Jersey with no exclusion. Okay, let's talk a little bit about life insurance quickly. Life insurance pays out to a beneficiary upon the death of the insured. One important thing to realize is that life insurance proceeds are not income taxed. So that could be a benefit. Somebody who has a big life insurance policy, your heirs are not going to have to pay any income tax on that. Life insurance proceeds, though, are estate taxable if they're not in a trust. So people do use life insurance for estate planning. That was much more common when the estate tax exclusion was much, much smaller. Now it's really not so common because you would have to have such a huge life insurance policy to make it worthwhile for the size of the exclusion. It may not make sense for a lot of people. It's certainly not within my area of expertise, shall we say. But you might have done some estate planning before these new rules, and we also don't know what's happening to the exclusion, so you might do some planning after it. If you do have life insurance in a trust, it's in what's called an irrevocable life insurance trust. So let's talk about beneficiary designations. We finally circled down to that. So for your IRA, your 401k, your 403b accounts, basically your qualified retirement accounts, you must designate your spouse for those accounts unless your spouse agrees that he or she does not want to be designated. So if you designate somebody else, then your spouse has to sign a waiver. An important thing to realize when it comes to beneficiaries is that we had the Secure Act, which was just passed in December and came into play starting January 1st, which added some new rules for inheriting IRAs or 401ks. Unless the beneficiary is a spouse or one of the other exceptions, whatever the account is has to be fully distributed by the end of year 10. So, if you leave $1 million IRA to somebody, they're going to have to take income of $100,000 a year, if they do it evenly, in order to distribute that IRA by the end of year 10. If they could choose not to take any distributions because there's no longer any required minimum distributions for inherited IRAs, and so they can wait and take $1 million distribution at the end of year 10. Of course, they'll be in the highest tax bracket. There's an exception for your spouse. If a spouse inherits an IRA, they can do what's called a stretch IRA, or they can retitle the account into their own name. Which one they would choose depends on how old they are when they inherit the account. There's an exception for minor children. So minor children inheriting an IRA now, the IRA can actually stay as a what's called an inherited IRA, a stretch IRA, but it only can stay in there until the child reaches the age of majority, which is typically 21, but varies by state. There's an exception for disabled people. So if somebody who's disabled inherits an IRA, they actually can stretch that to their lifetimes. And there's also an exception for people who inherit who have a 10-year or less age difference with the deceased. So what we used to have is we used to have what's called a stretch IRA, where you could put the IRA in an inherited account and then take distributions over a lifetime. And that's no longer possible, as I said, with non-spouse beneficiaries. So best practices used to be naming a trust as the beneficiary of an IRA. So instead of leaving it, you know, Joe has an IRA, Joe is not married, Joe wants to leave the IRA to his son Sam. Instead of leaving it directly to Sam, you would leave it to a trust that names Sam as a beneficiary. The trust helps control the beneficiary not taking all of the money out at one time. Most attorneys would have recommended a trust. It also would help for minors inheriting. Well, that's no longer a good idea. Those see-through trusts no longer work because there's no longer any required minimum distributions, and it has to be distributed in 10 years. So most of the estate attorneys I know no longer recommend that. So if you still have a beneficiary like that, you should change it. So let's talk a little bit about vocabulary of beneficiaries. You can have a primary beneficiary, which is the first in line to inherit. You can have a contingent beneficiary. You can specify joint beneficiaries, in which case each person receives a fraction of the total. You can designate your beneficiary as per stirpes. That means if your beneficiary predeceases you, then their natural or adopted offspring will automatically inherit. So if you're let's say you're somebody who's married, you have children, you want to set up beneficiaries in your IRA. One thing that you might do is you might name your wife as primary beneficiary, your spouse, and then name your children as contingent beneficiaries. And if it was me, I would name my children per stirpes, because I'm not sure when they're going to have children. And if they have a child, am I going to go and remember to change my beneficiaries at that point? Or if I happen to die and my child predeceases me, don't I want that child's children to inherit his portion? So per stirpes is pretty useful for that. I think that many people want to use that designation. And another designation is per capita. That means if your beneficiary predeceases you, then their share actually goes to other primary beneficiaries, or to contingent beneficiaries if there are no primary beneficiaries. So let's say you know, you have two children, Fred and George. Fred predeceases you. George is then going to inherit 100%. That's what per capita means. If you don't specify anything, then it essentially is like per capita. So here's another type of beneficiary. You can name a charity. You could name the New York, New Jersey Trail Conference as a beneficiary. A charity does not pay income taxes. So if you have an account well, if you want to be charitable in your estate planning, let's put it that way. If you want to be charitable in your estate planning and you have qualified money and you have non-qualified money, and you also want to take care of other heirs, leave the qualified money to a charity, because the charity won't have to pay any taxes. Leave your non-qualified money to your other heirs. You also, another possibility, which I think we're going to talk about in our next session in a month, is using a charitable trust. You can actually use a charitable trust to simulate a stretch IRA. And you can use what's called a charitable remainder trust, which means the remainder goes to charity, but the trust will pay a non-charitable beneficiary. So here's a beneficiary checklist. Really, you should review your beneficiaries yearly. Any kind of change to the makeup of your family should cause you to take a look at your accounts and take a look at your beneficiaries. It could be a death of somebody, but it also could be the birth of somebody. Make sure that your beneficiaries are still alive and that you still like them. And a big example is divorce. People get divorced, you should be looking at your beneficiaries. Your children get divorced, you should be looking at your beneficiaries. You really should understand the tax impact to beneficiaries. So yes, you want to take care of your loved ones, but taking care of them with money pot A that they don't have to pay taxes on it versus money pot B that they do have to pay taxes, just understand the difference and understand their tax impact that they might have. And as I said, get rid of those see-through trust beneficiary designations for qualified accounts. You should probably talk to somebody, an attorney about estate planning. But those are no longer recommended because of the new rules in the Secure Act. And what's going to happen with estate planning? So, there's a lot of political information. I'm going to listen to the debate at 9 o'clock. I sure hope that it's more calming and less entertaining than the last debate. But whoever gets elected, there is probably going to be some changes. So the Democratic proposals, one of them is elimination of the step up in basis. Personally, I think this would be horrible, not so much from the point of view of taxation, but from the point of view of having to figure out what the basis is of everything that you inherit. Somebody lives to 100 years old and they leave you their estate. Luckily your parent lived to 100. Figuring out how much they bought whatever it is you're trying to value for, because that would have been the basis, the tax basis, is just a horrible job. I've had to do several estates myself, and I'm very glad I didn't have to figure out how much things were bought for. So, but that's a proposal. Everybody, they're talking about reverting to a $5.79 million exclusion. That's still pretty good for most people. They really haven't talked about portability. The higher estate tax exclusion is going to sunset on December 31st, 2025, and that might happen no matter who is elected, because who knows if whoever's in power is going to have the votes, even if they want to keep that higher estate tax exclusion. So it is very likely to change. And that's my general disclaimer about investment advice, but I don't think I gave any investment advice. And everything that I talked about, I believe to be true, but I might make a mistake. Make sure that you talk to your trusted advisors. And thank you.
Great, thank you, David, so much.
I'd be happy to take any questions.
I was just going to say that there's no questions in the chat box, but feel free if anybody has any, you could just ask away right now. If you're thinking it, somebody else is.
I have one. Jane has a beneficiary IRA from her mother. Should we change that in some way?
I'm sorry.
It's a Roth IRA I inherited from my mother.
No. Your mother died before 2020, right?
Oh, yeah.
Yeah. No. So for anybody who died before January 1st, 2020, they get to have those stretch IRAs. And that, you don't have to do anything. And a Roth IRA is the best. I didn't really mention that separately, but a Roth IRA, because it's not taxable and it's not taxable for the heirs, even with that 10-year rule, that's the best thing to leave to your heirs.
It's good to know. Any other
Anything else?
questions?
Even if it's not directly on what I just went over, I'll tell you if I know the answer or not.
This is Susan. I want to thank you, David. I don't actually have a question at the moment. I need to just think about all the information that you gave us. I've got some things set up already and I need to give some thoughts. I'm going to change a lot. I don't want to change some things, part of which is I want to start giving some of my money to charity and not necessarily just, I'm single, not necessarily just to my nieces and nephews. So I don't know what I missed in the first two because I didn't even know about them. I came in for this one, but I'm most interested in, of course, you're going to be covering in the next one, apparently, more about how you do charitable trusts.
Okay, sure.
I'll be an interested consumer of the next one also. I appreciate it. It's really been helpful. Thank you.
Okay, you're welcome.
Susan, I'm going to share the online library that we have. And the first one is definitely up, and I have to check to see if the second one is. So you can go back and you can see the other two that we've had. And the next one, I'm not sure if David mentioned it, is called Advanced Planning Using Charitable Remainder Trust to Manage Taxes and Create Lifelong Income for Your heirs.
Yeah, great. And do the other ones have, I know that you had mentioned, David, about some of these slides. I don't know that I need all of the slides, although they probably come in a batch. I was they come all together, but is it possible to see the slides from the other presentations or no?
Yeah, I mean, I have the slides for all the presentations, so I could pass them to you if you want to send me an email, or I could give them to Jennifer.
If you, whatever is best for you. What's easiest for you?
Both work.
Okay, why don't I send you an email?
Okay.
And that way, Jennifer, you're out of the loop. You don't have to be in the middle of it. You got enough things on your plate, I'm sure, at the moment. Okay, wonderful. It's been really helpful. I know I was talking to my financial people about a charitable remainder trust from a piece of real estate that we're probably going to end up selling and turning and possibly putting my part of that, because I own it with somebody else, joint survivorship, and turning that part of it, because I don't necessarily need the money, into something where I leave it to a charity but benefit from that for the next whatever years I'm alive, and then the money goes right to the charity. So I assume that's sort of what you're, if I understand it correctly, that's what part of what you're going to be talking about next time.
Yes. And I will try actually to get an attorney to do this with me next time. But so a charitable remainder trust, you could actually transfer the property to the charitable remainder trust and then sell it in the trust.
Oh, really? Okay.
So yeah, if you have an attorney, you should be asking about things like that. Now, if you own it with somebody else, that could have some complications, especially, they might have different, or probably shouldn't be the same trust. And I have to tell you, I'm not an expert on that, but whatever you do, one thing I know for sure is before you actually sell the property, make sure you explore the best way to handle the charitable portion of it.
Okay.
I did talk about donor advised funds. They also take property. You can donate property to the donor advised fund, then the donor advised fund sells it. That doesn't provide any income to you. That would be something that would then end up going totally to the charity. With a charitable remainder trust, you can provide income to you, and at the same time, the charity will get the remainder. You get a good tax deduction for that remainder portion up front, which can shelter gains on the sale.
Yes, that would be great. I owned my office building. It was a two-family house with an office, and I own it with my brother. Now they're going to want the money, but I don't really particularly need the money. So I think that may be one of the things that one of the ways I give to a charity is set it up in that particular way. So it benefits me while I'm alive, but it's already set up to be designated to that charity. And I assume it's designated to a specific charity. That's the point.
Yes.
Okay.
You would typically designate it to a specific charity. And it's best practice to probably have a contingent charity, because you never know, charities come and go, depending on the charity. The trail conference isn't going anywhere, but but you would name the charity, I believe. But again, I'm not an expert. Maybe there's a way of doing it where you don't have to name the charity. Or you could at the same time create a private foundation. It all depends on, the amount of money and whether it's worth it for legal fees and what goal you're trying to accomplish.
Okay. Well, I won't tie the other people listening into this, because I'm sure we're going to talk about more of this in the next session. But I just wanted to thank you, because I realized I don't quite know enough about how I got this all set up. And listening to you, and especially in deciding to leave, assuming that I didn't spend all my money, leave it into charity and not only to my nieces and nephews. That's sort of a new decision. So this is very timely for me to be able to hear about this. And of course, the Trail Conference is what the trees and the animals are my love. So things that those kind of charities are the ones that I'm interested in leaving to.
Right. And in the trust, just like in a will, you can leave it to multiple beneficiaries. Basically you can specify it any way you want to.
Well, I assume like with the people beneficiaries, you need to be checking periodically about where those charities you designated are at. I mean, like I said, the Trail Conference has been around for a long time. It's not going anywhere anytime soon, but I'm sure you need to do the same thing with your charities, is periodically make sure they're still there and being run well.
Yes. So, and again, I'm not sure how you would specify this, but you probably can give the trustee of the trust some leeway in choosing a different charity. I would think that that's possible.
Okay. Well, thank you.
Okay, Maida asked another question. Is the estate tax paid out of the estate before it's distributed to beneficiaries? And the answer is yes, that is the way it is supposed to work. It is up to the administrator of the estate to make sure that that is accomplished. That's the administrator's job. And the administrator is actually personally responsible for the taxes if it didn't happen. But there's nobody who says, oh, you can't do that when you're the administrator. So if you paid out to beneficiaries, it can be very awkward to have to claw the money back when you have to pay the taxes. Okay. All right. So if there's nothing else, thank you, everybody. And I'll be talking with you next month.
Yep, and please, David's email is on the screen, so feel free to email him directly, but you could also have my email, and feel free to email me any questions and I'll redirect them to David. But thank you so much, David, as always. Our next one is November 4th, which might be a heated day for some people, so you might want to unwind with some financial advice to help you decipher it all. So thank you for joining us.
We won't know any answers. November 4th, we won't know anything. So
it'll be a good series to tune into. So thank you again for joining us. I hope everybody is enjoying the changing of the leaves and getting out there and having some fresh air and some good hikes. So thank you, and we will talk soon.
Thanks, Jennifer. Thanks, David.
all right. Bye-bye.
Bye-bye.
Bye.